All right. So tonight we're going to be covering chapter 4, the secondary market. So we're going to go ahead and get started with chapter 4. Now, the primary market we've talked about previously. The primary market is where you end up, Mr. Eugene, if you need to borrow money to pay Aiden to build that swimming pool, you would go down to the Bank of Grossman, and in that situation, you can end up, he gives you money, okay? So you go to the particular bank in that particular situation. So you go down to Mr. Grossman, say, hey, Mr. Grossman, can I have $500,000? And Mr. Grossman pull out cash out of his wallet and give it to you, okay? So that is primary. You're going directly to that individual. Travis, why are you beating up Stefan back there? Oh, you're just trying to get some money out of it? Okay, that's just making certain there. So in that situation did I need to give Stefan's address out to everybody? Okay. No, but in that situation what ends up happening is that you are going to end up, you're going to go primarily to the bank. So you're able to go a primary market is we go directly to the lender, to the person, and we take out the money, okay? So you physically go there. When dealing with the secondary market, though, it's completely different, because what ends up happening is you do not deal as individuals with the secondary market. You are dealing with the secondary market from a different standpoint, okay? What I mean by that is when if Mr. Grossman was to give everybody in this class an entire training, or money, and he gave us all money to purchase a house, he could pack all of them and put them into a pool and sell them off. And when he sells them off, what he's ended up doing was he has ended up selling it off for an investment. And when he sells them off, he sells them off at the secondary market. So it's where banks are selling off their investments or their debts to investors in order to get money back while the investors hold the debts, if you see what I'm saying. Okay? So, who are some of the secondary money or mortgage market players? Well, this is going to be Fannie, Freddie, Ginnie, and Farmer Mac are the normal ones that you hear, okay? And there's also the Federal Home Loan Bank. You have your REMIX and your Federal Housing Finance Agencies. Again, all of these have some type of federal background, some type of federal type of transaction. So what's happening is that the government allows these people to end up buying those debts, those pools, and end up in this particular situation. They're able to then hold those debts, and you're paying payments to these holders of the debts, okay? Now, this does not mean that if Mr. Grossman was to give out notes, remember we talked about prime and subprime, okay? Prime loans are loans that meet a very high standard, meaning that Mr. Aiden, he makes $250,000 a year. So, and he has great credit, pays everything, never had any bad negative information on it. He's got a great history, okay? So his loan is prime. But if you got, say, Miss Linda, who has, she's basically, she's went over her stuff's in collections, she makes $20,000 a year, works at McDonald's. Well, she's not going to be a prime suspect or prime person to end up that's going to most likely pay back her debt. Her chances are pretty slim, if that makes sense. Okay, so when dealing with these agencies, Freddie, Fannie, Ginnie, any of these different agencies, what occurs in this particular situation is that these different governmental agencies are going to look at, do the loans that we are about to purchase, are they prime or subprime? Now, who are they most likely previous to 2008? Who did Fannie, Freddie, Ginnie, and all them rely on? They relied on appraisers and the lenders to tell them, is it a prime or subprime loan? But here's the problem, is that unfortunately, like we try to tell people all the time in this situation, unfortunately, what occurs is that the lender may actually have serious intents that these are all prime loans, but guess what? They're actually they're subprime, because guess what? The appraiser lied to the lender and ended up creating this issue. That's why a lot of these organizations, Freddie, Fannie, and Farmer, and all of them, in 2008, had a major issue, very big issue, because the fact is it wasn't something that was expected. It was not expected by any means, because the fact is prime and subprime were all mixed together. Okay, so when you put prime and subprime, guess what ends up happening? You get a pretty high chance of that whole thing's going to collapse. Okay, so in that situation it causes very difficult times for the individuals that are purchasing those debts to hold them. Now, Fannie Mae was basically originated as a governmental agency in 1934. I think that's the year that Aiden was born, actually. So in that situation, yeah. So in that situation it originated in 1934, and it was rechartered in 1954, and then it was reorganized under HUD in 1968. Okay. Their primary job is to purchase conventional and governmental loans through an administered priced system. Okay. Their job is to purchase those conventional or governmental loans through their particular system, their platform. They do sell mortgage-backed securities, which are going to be called MBSs, and they basically are placed in conservatorship with the Federal Housing Finance Agency, which is FHFA. Okay, so in that situation, this entire conglomerate, you could say, basically its duty is to go in and purchase things to help basically fund the economy, keep the economy going, but also in the same situations, they do also sell mortgage-backed securities as well, okay? And they basically make money off of holding the conservatorship by providing that through the FHFA. Now, Fannie Mae has this underwriting standard, okay? And if you're a real estate agent, you're not ever going to deal with this, okay? However, for the test, they feel that it is imperative that you as a real estate agent know what Fannie Mae's underwriting system is. I don't know why, but they feel like you need to know that their underwriting system is the desktop underwriter. Sounds pretty outdated, don't you think? Okay, desktop, how often do y'all hear that anymore? Not very often, okay? So it's called the desktop underwriter. And they basically provide very strict guidelines for conforming loans. Okay, let me say that again. They provide very strict guidelines for conforming loans. So what I mean in this particular situation is that the loans that are written, okay, are going to end up, they have to meet these standards, okay? So they set an annual maximum loan amount that can be provided. They do require PMI, private mortgage insurance, less than 20% down payment. If you're going to have less than 20%, you have to have PMI. No ifs, ands, buts about it, okay? Now, what is PMI? A lot of people are like, what in the world are you talking about, PMI? PMI is this. PMI is guaranteed that if, say, Aiden fails to pay his payments, It is mortgage insurance that the lender is going to get some of their money back, if not all of their money back, in regards to the transaction because Aiden failed to do his job. Okay? So basically, Aiden, you're paying for insurance for the lender in case you default, they get the benefits. How do you like that?
Not good at all.
Unfortunately, that's how it works. Okay? Now, there is a requirement, however, on certain loans, and this one especially is the down payment. You have to put down a minimum of 5%. Now, a lot of times when I talk to my agents, we always calculate everything based off of what percentage, Mr. Grossman? You remember?
35.
3.5. 3.5%. Okay. So for every $100,000, how much is that, Mr. Stahl, that you have to put down? 3,500 bucks.
Yep.
For 100,000. Okay. So for every 100,000, your client has to put 3,500 down. Okay. Now, the qualifying ratios. What this basically sees here is you got 26 over 36 is basically the standard. What they're talking about, that's 36. Oh, I'm sorry, 28 over 36. My bad. 28 over 36 standard. What that basically comes from is this. It's the amount of debt that you have. Okay? Most of the time, they're going to end up, your debt, your monthly debt, cannot exceed 28 to 36% of your total income. Now, why, Aiden, is that important? Why should your debt not be more than, let's say, 28 or 36%? Why is that so important? Well, if I'm spending 75% of my money every month, how am I going to pay for a $1,200 mortgage? Not going to. Okay. Also, on these loans, the seller can only contribute 3 to 6%. And I've had that issue before. Ended up, buyer wanted a lot of things repaired. It's a $200,000 house. Seller didn't want to fix anything, just wanted to give money, just get rid of them. The seller said, I'll give them $20,000 in repairs. Okay? $200,000 house. I'm like, all right, let's put it in there. Get everything done, get to the closing table, and guess what we find out at the closing table? There's a cap of 6% on it. We had 10%. There's 4% that's missing. At that point, we kind of were in a bad situation. Okay? So in that situation is, you got to be aware of these limits of contributions. Your clients are going to end up, if they want to go over in a situation, Mr. Nobles, say for example, that you end up, sir, your client wants to do a lot of repairs and they want 10%, you need to, it's probably in your best interest, you need to call the lender and ask the lender, can I do a 10% seller contribution? Because they may tell you no. Now, Mr. Travis, if they tell Mr. Eugene no, that he cannot do a 10% contribution, then what should Mr. Eugene do? Just give up on it? No, what should he do? He can only give 6. He has 4 left over. What should he do then? Calculate that 4% and do what with it? Subtract it from where? From the sales price. Okay. Calculate it from the sales price. Or calculate how much that 4% would be, and then take it off sales price and drop sales price and leave it at 6%. Okay? But you got to run your numbers. That's the only part in this entire field that you got to run your numbers. Okay? You have to make sure your numbers jive. Okay? They have to jive. Now, if you have what's called a jumbo loan, these exceed the loan limits, and these are often non-conforming loans. Now, jumbo loans are basically loans that are not going to meet these strict requirements. And a lot of times, jumbo loans are going to be used by people that buy very high-end houses. Very high-end houses. It's not that Aiden is broke and he's poor. It's just the fact of the matter is guess what, Aiden? The amount you're asking for exceeds that maximum loan amount stated above. So Aiden may end up, they may say maximum loan amount in his area is $450,000. Okay? Well, it's $450,000. But Aiden's wanting to buy $1 million house. Well, because of that, Aiden, guess what, man? You got to figure something out, right? Okay? So they have to do a jumbo loan. Okay? They have to end up doing a jumbo loan. Now, Freddie Mac is basically, it was established in 1970, and it's to provide the secondary market for savings associations. Again, they also purchase conventional as well as governmental loans, and they were placed in conservatorship with FHFA in 2009. Reason being is because, remember, Freddie and Fannie ended up, they had to end up going into conservatorship because of the fact of the 2008 crisis. It almost bankrupted them. Okay? So they had to be put into FHFA, and they ended up having to now follow the rules under the FHFA. Now, Freddie also has a very strict underwriting standards policy as well. And they use what is called the loan prospector. Okay? That's their underwriting software. So in that situation there is the similar, they're going to be very similar to Fannie in regards to the uses of their debt to income ratio, right? They also, in the same situation, they have qualified residential mortgage standards, which are QRMs, okay? And these are the standards that in that particular situation that have to be met, okay? Just like what we talked about right back here, there are certain standards under Freddie that you have to meet. You fail to meet those standards, guess what ends up happening? You can get in trouble, okay? So we have to make certain that we are meeting these standards, all right? Failure to meet these standards, your clients can end up running into issues. There's, of course, the Ginnie Mae, that's also another one, and they basically guarantee FHA and VA-backed securities. There is the Federal Home Loan Bank, which buys loans from savings associations. There is the Farmer Mac, which provides secondary market from farm loans. And there are the REMICs, which are your real estate mortgage investment conduits for pools of mortgage-backed securities, okay? And those had a lot of issues back when 2008 kind of just went tanked, okay? So, with that being said, as you can see, there's a lot of material. Now, here's what's going to happen. See, I had pretty little slides here for y'all today, but we're not done. Don't get happy. A lot of people are smiling thinking we're done. Oh, no. No. Okay? We're just getting started. Okay? So here's what's going to happen. I found a very good video that I liked that does very well that I want you to watch. The individual that teaches the material does a very good job. I want him to end up, I'm going to put him up here and play the video here in a second. He's going to go through some things. But he's also going to go through some questions. Okay? Now, I will fair warn everybody. The video is a little blurry. It's a little bit dated, but it's not extremely out of date. Okay? And still, the content's very good. But I'm going to put the video up. I want y'all to watch the video. I want you to listen to it. Now, he teaches different from me in regards to the fact that he actually talks to his students. So he'll talk to a student like he's having a dialogue, and then he talks about the material and asks the student. So you will hear a student talking to him, and then he's going to ask questions of the student. But I want you to go through, and I want you to listen to this. Okay? We're going to go through that, and then we'll continue from there. Okay? So give me just a second while I get everything set up here. Just a moment here. Okay. All right.
This is Joe from Prep Agent, and I am here today with Carol, a new student getting ready to pass her real estate exam. Hello, Carol.
Hi, Joe.
How you doing?
Pretty good.
Not as good as you say you are, but you're a little nervous. You call me a little bit of panic, right?
Well, yeah, exactly. This isn't the most fun stuff in the world, but I gotta do it.
You got to do it, but we'll make it a little less painless, and we're going to focus on a topic that was giving you a little trouble. And what topic is that?
The real estate thing.
The secondary market.
Yeah, I know.
Yes, don't worry about it. I know the whole exam can be daunting, but we were talking about the secondary market before.
Okay.
And a lot of people do because when you study other stuff like appraisal, it's much more tangible. You see the properties, the definition a little simpler. Secondary market's very ambiguous to people. It's not something your average person comes across. So it's a little harder for people to wrap their head around. But we're going to try and make it a little more manageable for you today. So we move forward, it's less daunting on your real estate exam.
Okay, I appreciate it. Thanks.
Yeah, no worries. And let's narrow down our points of trouble from real estate exam to more specific things. What do you think?
Okay.
Okay. So first piece of advice to give everybody, don't overthink stuff. Remember, my motto, smart is overrated. You don't want to overthink everything. Keep it simple, keep it easy, keep it concise. You can get very involved with the secondary market, but there's just a few simple things you need to know. And it all starts with this. The secondary market is the resale marketplace of loans. Can you read that back to me?
The secondary market is the real resale market of loans.
Do you know what that means?
Not really.
Doesn't matter. If you see that, circle it on your exam.
Okay.
Either you know what it means, just circle it. Because that is the core. Now I'm going to explain a little bit what it means, but this is the core of everything. So remember, like it's Greek or whatever language you don't know. The secondary market is the resale marketplace of loans.
Okay.
Are you a history buff?
In some areas.
Okay, so sometimes knowing the history of something will really help explain the concepts. So let me take you back to 1934. Tell me what you know about 1934.
The Great Depression.
There you go, you're on a roll. Great
Okay.
Depression.
Yeah.
What do you think, now you obviously don't know this much detail, but you're a smart person. What do you think real estate-wise is going on during the Great Depression?
My guess would be hard times, deflation.
Okay. So really it was a society full of renters. And what I mean by that, only the very rich could own property. So most of the society had to rent. And as you go into real estate, you know that to build wealth, you want to own property. So there's a classic case of the rich getting richer and the poor struggling to keep up. Because as we know, poverty can be like quicksand. And part of that is paying exorbitant rents, trying to keep up, where you're not getting any money back through equity building and depreciation of the property. So that was part of the problem of the Great Depression. Let me get a little more specific. Back then, to get a property, you had to put down 20 to 40% on the property. 20 to 40%. That's a lot of money. Think about terms today, we don't put nearly that amount down on a property.
True. Yeah.
And the loan amount was 7 years. So it was a 7-year loan, and it was a straight note. Okay, meaning you only paid the interest. 7-year loan. So if you think about it, what's the issue with that?
The issue is most people can't afford it.
Yeah, so most poor people can't afford to put 20-40% down. Even today, that wouldn't be realistic.
Yeah, I wouldn't be able to do it either.
Yes. Okay, so 20-40% was a large down payment. And in 7 years, the bank would have the money back. So what does that mean? That means the bank had money to lend out over and over again. So remember, they were getting 20-40% down, and the loans were being repaid back after 7 years.
Okay.
So it worked for the banks. They could keep lending to the rich people who could afford to take out the loans, but the lower class and the poor was left out. This made things a lot worse, and it helped contribute to the Great Depression. So what happened was in 1934, okay, so 1930, 31, 32, remember Shirley Temple? You were a big fan of hers, right?
Yes, cute.
Yes, 1930s. 1934, something happened in the real estate world. Very exciting. You know what it was?
No,
Something called the FHA. You ever heard of the FHA?
I certainly have.
Yes, it's probably something you saw in your books where you're like, what's that about? I've heard of it, but I don't exactly know what it is.
Okay,
So what the FHA did is they stepped in. And this was a government organization that said, we got to do something about this. It's getting out of control. Depression's going crazy. So what the FHA did is they decided to insure the lenders from loss. They told the lenders, hey, instead of doing this 7-year and 20 to 40%, why don't we do something more reasonable like 3%? And why don't we do it over the course of, I don't know, 30 years, which is more what you see today, that 30-year loan. The banks were like, well, that's crazy. We don't have money to lend out. What if people default? And FHA said, no worries, we will insure you from loss. So if anything happens, we got you covered. But in doing that, a new problem arose. What do you think? So now banks were collecting, so you want to get a house. You gave me 3%, and you're going to pay back over 30 years.
okay.
Where it used to be, I would get the money over a 7-year period. So what's the issue for me now as the lender?
Whether in the Great Depression I keep a job for that amount of time and can consistently pay?
Well, that's what the FHA said they would help.
Okay,
There's another issue here for me as a bank, as a business. Remember, before I was getting 20 to 40%
yeah,
down payments, and I was getting all my money back in 7 years.
yeah,
So the next guy wanted to borrow money, wasn't an issue for me. Now I'm lending money to people who aren't paying me back in 30 years. So what's my issue?
having enough to loan.
Exactly. There you go. So now I don't have the money to lend out to the next guy. So my business model is kind of screwed by this.
Yeah.
So the FHA, right, insured the lenders from loss. Now keep note, FHA is not a lender. They just insure the lenders from loss. But what this did is created a situation where I lost capital. I don't have capital to lend out to new people. Does that make sense?
Yeah, it does.
Okay, so this is where the secondary market came in. The secondary market's the resale marketplace. They would buy those loans from the FHA, okay, or buy those FHA insured loans, let's say that correctly, resell them. And now the lenders have the capital to lend money.
Okay,
Does that make sense?
makes sense.
And now you know why, when I started this lesson, I said think of it as the resale marketplace.
Okay,
So essentially, I can lend you money, and I need the money back, so I'll resell that loan to the secondary market. They can wait to make money over a longer period of time, like 100 years, it becomes less for the stock market. They buy it, and now I have the money to lend out to people. Sound good?
yep,
Now, the FHA insured the lenders for losses. The FHA made a very desirable loan to resell in the secondary markets. Insured, to do that, they have to verify the borrower's employment, have the property appraised by a neutral third party, and have a title search, which shows the history of ownership.
okay,
Borrowers charge a one-time upfront insurance premium, and if the borrower defaulted, the FHA would pay the difference. Key point here, FHA does not make loans. You don't go to an FHA office to get a loan. There's no such thing. FHA is an insurance place for lenders.
okay,
Okay, so I hope part of this background puts a little more in context for you. to
It does.
understand the secondary market.
yeah,
Okay, 1939, Fannie Mae bought an FHA insured loans from lenders. It's a government institution. Have you ever heard of the VA?
yeah,
What's the VA?
Veterans Association.
Yeah, so the Veterans Returned from War in 1935, Fannie and Mae agreed to buy VA guaranteed loans that the lender had negotiated. Fannie Mae buys mortgages on the secondary market, pulls them together, then sells them back into mortgage securities to investors on the open market. That's a little more complicated way of saying what I was saying before. They take the loans, they create them, sell them on the secondary market, and then they have the capital in order to make more loans. Okay?
Yeah, I get it.
You're going to hear a term called warehousing. Have you heard this term before?
No,
Warehousing is when they package the loans and sell them in a group. Kind of like when you buy a 6-pack of soda. What's cheaper, buying a 6-pack of soda or buying 6 individual sodas?
6-pack.
Right. So warehousing is like a 6-pack of sodas.
Okay.
Okay. And they sell them on the secondary market. They package the loans, they sell them all as one. Ginnie Mae is a federally owned corporation, Department of Housing and Urban Development, and they ensure liquidity. Do you know what the word liquidity means?
I think in terms of if you liquefy whatever you own, what it's worth.
Yeah, it's basically turns things into cash.
Right.
Makes the money more movable. Just think of the word liquid. What does liquid mean? When you think of the word liquid?
Flow.
Flow. Exactly. It moves easily. So when you think of liquidity for money, just think of it like liquid. It flows easily. It can be easily moved. In summary, secondary market resells loans to which help provide fund for lenders. Oh my gosh, please excuse my spelling error. Everybody who sees this, do not spell resell with an L like that.
Okay.
So, disclosure, I've identified my error. So won't put all the comments on YouTube, please. Kyle, do you see any other errors here so people don't trash me on YouTube?
Let's see, secondary market resells loans to which helps provide funds for lenders. I could put a period on the end, but on that we're okay.
See how smart I am? You think I misspelled, but really I just made you reread that sentence for everybody watching this on YouTube.
Okay.
See, that was all pre-thought, so haha, let me on YouTube there. Okay. Here's your favorite part, questions. Dun-dun-dun-dun. So unfortunately, we're going to expose your weakness, but I want to congratulate you. You exposed your weaknesses. You're helping a lot of people, including myself as a teacher and other people trying to learn. And I'll do these questions with you, so I'll help explain concepts as we're working on them.
Okay.
All right, so just do your best and don't be afraid to get it wrong, because rather get it wrong now than on your exam.
Fair enough.
All right, why don't you read this out loud?
In which of the following markets may a lender sell a loan that a mortgage banker has previously originated? Secondary market.
Look at you, you're already doing well. 100%. Okay, why did you circle secondary market?
Because that's what we've been talking about.
And what I'm getting at, and I'll say this a lot as you prepare for your exam, if something's familiar to you, circle it. You never circle things that you've never heard of before. Because if you study a lot for this exam, you're going to see things that become familiar. If something in your exam you've never seen before, that means it's not your material, you don't need to know it, don't circle it. Okay?
Okay.
Okay, which of the following markets may a lender sell a loan that a mortgage banker's previously originated? What's the answer?
Secondary market.
Boom. Okay, great.
Am I supposed to sit in here with all?
A VA loan may be granted for the purchase of a 1 to 4 family. Okay. Okay, VA loan may be granted for the purchase of a 1 family to 4 family property if, what do you think?
The down payment will be at least 10%.
No, so the answer here is the veteran agrees to live there. We did
Okay.
not talk about that in the lesson, so don't
That's
feel
true, we
bad.
didn't, I guessed.
Right, so don't feel bad about getting that wrong.
Okay.
What I want you to learn from this is you're getting tested primarily on residential real estate.
Okay,
So remember that, people live in residential real estate. The
okay,
VA insures loans, but they're not insuring loans so people can make money. They're insuring loans so people have a place to live. It's making sure veterans have a home, not making sure veterans can get nice income properties and things of that nature.
okay, all right,
That's why
thanks.
default to answer on your exam will usually revolve around people's residence,
Yeah.
not collecting rent or things of that nature. Now, that's not always the case. It's a good rule of thumb to follow as you prepare.
Okay, I'll remember that.
Okay, so with that being said, what's the answer here? Going off what I just explained to you. Which of the following loans would be most likely to qualify for FHA insurance?
It would be a loan to purchase 1 to 4 units of residential rental property.
Right, and what we're getting at here, we didn't talk about a lot about that, but going off that rule of thumb I just gave you, you're saying, you know, I'm not sure here, but going off that rule of thumb about residential real estate, there it is.
That's exactly what I did.
Yeah, and so that will really help you as you prepare for your exam. Which of the following statement is most accurate concerning mortgage bankers?
They negotiate loans which are readily saleable in the secondary mortgage market.
You just got another one right. I want you to remember, you said you knew nothing to start this lesson.
Sure.
It's either I'm a great teacher or you need more confidence. Let's go with both.
Okay.
Lenders who deal directly with the borrowers make up the.
Probably to the primary mortgage market.
I love that you got that right. You didn't automatically circle secondary market because you paid attention and you said secondary market's a resale marketplace. So that's not dealing directly with borrowers. So the primary mortgage market is the answer there.
That's exactly how I thought.
Excellent. What you're also learning is in order to pass this exam, if you know a few simple rules of thumb and you know some key words and know some key concepts, you can get by and you'll be okay. So as we started with you when we started this lesson, there's a feeling of insecurity. And my hope as you're doing this, you get a little more confidence saying, you know, I can handle this if I just understand some important concepts that are relevant to what we're doing. Which of the following loans on a home would probably be made without requiring a down payment from the borrower?
VA.
I don't know how you got that right, but you did. VA, that's one of those you just gotta learn. VA does not require a down payment. Just out of curiosity, I did not say that in the lesson. How did you come up with VA? What was your thought process?
Well, you were talking about the previous question and the idea was just to give someone a residence, and we were talking about veterans. So in a way, it was an educated guess that this would apply to the veterans.
Excellent. Good. So the other thing you see is GNMA is Ginnie Mae. You learned before they buy things on the secondary market, right?
Okay, yeah,
Conventional, we haven't heard that word. We didn't mention that today. FHA you learned about.
right.
So then remember I said FHA needed a small down payment. I told you that story, I referred to it as 20-40%. I didn't say FHA said no down payment. I said it was much smaller down payment.
Okay.
And so you came up with VA.
Right.
Primary activities of Fannie Mae in the secondary market involves which one?
FHA loans only?
Government insured and guaranteed loans, which FHA is one of.
All right.
Just for the record, if this was your exam, you are passing your exam so far.
Okay.
Like that little animation there?
Yeah.
Fannie Mae, Federal National cash flow mortgage sources are primarily created to.
Let's see. It would be, it would either be A or C. So increase the availability of secondary financing or serve as a secondary mortgage market. I think I'm going to, go with A.
You're so close. Increase the availability of secondary financing. That would increase the people like on the stock market's ability to buy things. It's nothing to do with them.
Okay,
So it serves as a secondary market. But your thinking was great.
right, the key word was mortgage market. Okay, got it. I see where I messed up.
All the following are considered advantages of FHA except.
Let's see, the buyer is protected with FHA insurance
You were doing awesome. Why'd you answer that one?
because it's the lender that's protected by the FHA insurance.
I am so impressed with you. That is great. And you swear, when we started this, you said you knew nothing about the secondary market, correct?
Correct.
You're killing it. Purchaser of a home 5 years ago is now interested in securing an FHA loan. The salesperson will most likely introduce the homeowner to.
A conventional bank or savings and loan.
Right again. Just remember, the FHA is not a lender. And
Right.
the Fraser Unit doesn't make loans. And
Right.
what's the Federal Home Loan Bank?
I don't know.
They
That's
don't
exactly,
regulate.
that's
Excellent.
exactly how I got that answer.
You are going to be a real estate licensed professional. Not knowing anything about this. Term mortgage warehousing refers to what?
C. Oh, I think it's either A or B. Let's see. I'm gonna go with B, selling loans.
Yep. Secondary mortgage market is the market in which promissory notes are exchanged. Which of the following is not considered a major player in the secondary mortgage market?
Sally Mae.
Great.
We haven't heard that name before, that's why.
Rules of thumb. So you're part learning new information, you're part learning test taking techniques here. as well.
Yes, exactly.
No.
Who would be responsible for paying a 1% origination fee on an FHA loan?
C, the buyer.
What's your goal? To learn or pass?
To pass.
Pass. Yes, learning's later. Learning later.
Well, learning will come from experience, that's when it really sticks.
Yes. And obviously, do I want people to learn? Of course I do. I'm just kind of joking with that. But really, we want to get past things later. And you're doing such a great job of seeing, you know what, I don't really know this stuff. There's a few key things that if I understand, I'm going to pass without really having in-depth knowledge of this material. And you're really doing well with that. Do I want that in-depth knowledge? Obviously, I do. But that may not be realistic before your exam.
Yeah, that will come organically with the first year experience.
Yes, exactly. Borrow bought a $74,000 house with no down payment. The loan was probably what?
A VA loan.
After your teacher's
Done.
up and left.
Going with logic here, you'd say out of this group, who's the most likely to earn a no down payment loan? A veteran.
Exactly.
Yes. When purchasing with an FHA financing, a new buyer would normally do each of the following except what?
C.
Ooh, apply to a local FHA office. Remember, the buyers don't go there.
Okay,
That one I think you just answered too quickly. The correct statement about the Federal National Mortgage Association is that it is.
okay. That it provides guarantees to lenders on certain mortgages. No, purchases certain mortgages originated by lending institutions, right. That one, I went with for the answer before I read all of them, and then when I read the fourth one, I realized it fit more.
No worries.
Okay,
The term warehousing and used in real estate financing means what?
a mortgage company collecting loans prior to resale.
Excellent. Do you remember my soda example?
Yes, I did.
FHA was primarily created for what reason? To provide what?
Let's see, insurance for home loans made by approved lenders.
So good. Ugh, reading. Which statement best describes a VA loan?
Okay, you gotta give me a minute to read this.
Well, if you skim through it, there's
Okay,
certain things that just stick out.
all right, I am right now.
So what sticks out to you? Skim through it.
It would be D, a loan funded through the U.S. Department of Veterans Affairs for qualified veteran on approved properties.
Okay. So it was one of two. It's either A or D.
Yeah.
When I'm saying skim through it is veterans. The other two didn't have veterans as part of the answer. VA loans is clearly for veterans. So
Right.
you should have narrowed down to A and D. You went with D, A is correct, but your thinking was in the right path.
Right, and I didn't actually get to that when I was skimming. I did not get to with no down payment required, or I would have picked A.
Excellent. Good.
Okay.
You should get this really quickly because I think I actually asked this one before.
Okay. Selling loans on the secondary market.
Excellent. Good. You should get this one very quickly. VA loans, unique feature about the payments which are required is
There may be no down payment.
boom. So now what's happening, you're starting to recognize keywords.
Yes.
Buyer who wants to take out an FHA loan should refer the buyer directly to
D, and any approved lending institution such as a bank or savings and loan association.
good. Excellent. So you did awesome today. Super happy with you. Super with what you accomplished today. I hope you're happy too. Do you feel like you learned something today?
Yeah, thanks, Joe. You're a great teacher. I really appreciate it.
Thank you. Thank you. Just tell my sister that. She always criticizes
Okay, I will.
me. Yes. So what did we gain from today? Not only with the lesson about the second.
Okay. So he provided you all very good information in regards to basically a background regarding the material, but also provided you some questions. And I like to kind of bring that in sometimes throughout the classes, just because of the fact is yes, the material is important, but you need to see exactly how it's going to be worded. Okay. When you end up taking your real estate exam, the key thing when we get to the prep course that I'm going to tell you is take as many practice quizzes and questions as you can, period. Okay. The more you take, the more you understand. Okay. So if you were to say, hey, what do I need to be doing right now, Mr. Nobles, while I'm going through the classes? Well, you want to prepare for the licensing exam? Start studying some practice tests. Go in, there's plenty of different Texas-specific practice tests that are out there. The more you take, the more odds are that you're going to pass, okay? So very important in that situation because you want to make certain by all means that you understand the content, you understand the material, and you understand how it's applied. Because like I tell my students in just everyday life, I can tell you information, but putting it into practical aspects, completely different, okay? You can ask Aiden, you can ask Stefan, and you can ask Travis. All of them will tell you. Each and every one of them, there are different situations, okay? One thing I do want to add into this about the secondary market, going back to the the 2008 issue, you never want to force your client in purchasing a house that is at the top of their approved limit. So if Miss Linda is approved for $500,000 for a house, okay, does not mean, Aiden, you need to go push Miss Linda to spend $500,000, okay? Because the fact is, you do not want Miss Linda going and becoming bankrupt because you just want to get a bigger, fatter check, okay? You make certain that you help your clients. You guide your clients to make rash and sound financial purchases, okay? You never want to push them because the fact is, God forbid, they go over there and they end up, say they lose their job. Well, if they lose their job, they're SOL, okay? So in that situation is, you don't want them coming back after the fact and saying, Miss Linda saying, well, I lost my job, Aiden, it's all your fault, now it's all you, and now I'm homeless and my kids are starving and you're just a terrible real estate agent. You don't want that, okay? You want to end up in that situation is, you want to advise them. There's been many times myself when I've talked to a client and I told a client, I told them directly, I said, basically right off the top of the deal, I told them, I said, I know you're approved for $400,000, but do you really need a $400,000 house? Okay, do you really need it? If you are operating a business or you have a bunch of children or things to that nature, maybe, okay, maybe. But if you are, you know, it's a husband and wife and they're the only ones, what ends up happening in that situation? They don't need a $400,000 house, okay? Miss Linda, would you like to clean a 3,500 square foot home?
So that's my
Yeah, you don't need that, okay? Unless you're going to put Mr. Eugene on the other one end of the house and you have one end of the house. I mean,
No,
that could be a possibility.
no.
So, but in that situation is yes, you really don't need a very large house, okay?
No, he's not.
So in that particular situation, like I said, that kind of just guides you in that direction, okay? All right, so what I want to tell you is I do have another video I want to put up. I'm not going to make y'all sit through that video tonight. That's your supplementary video, okay? So I do want you to watch that if you get a chance later tonight. It's going to go in a little bit more detail on the secondary market. What we do want to end up making certain, tomorrow is half of the class is done. We knocked out half the class as of tomorrow. We will, by next Friday, be finished. Now, I've already had some students ask me, well, Mr. Nobles, how or when do we have to turn in our final and stuff to that nature? We will be discussing that probably tomorrow, okay? I have not made a decision in exactly how we're going to do finals and things to that nature. One method I'm thinking is possibly allowing y'all a week to complete everything and have it turned back into me the following Friday like I did the previous course, but we'll see how it goes, okay? Those of you that were in my previous class, assignments are due this upcoming Friday, which is tomorrow, okay? So, with that being said, like I said, we want to make certain everybody's staying on task. If you have questions, let me know. Remember, next Friday, we are halfway through the program. Next Friday, we're halfway through the program. Okay, yes, Mr. Travis.
I was gonna let everybody know, so the website I used for my prep exam kind of practice tests and everything, it's called Texas Exam Practice. It was like $30 or $35 or something like that.
Mhm.
But they actually break down where you can take questions over each course.
Ah,
So when I, like the class I was doing with you, and when I was doing the finance course, I would kind of just answer questions about the finance course. That were finance exam questions that they would ask on the test.
okay.
And you can kind of separate it that way, and then once you do all the courses, you can go back and just have one, a mix of all of them, and it'll just ask you random questions and everything.
Okay.
But so that kind of helps you separate it out where you can kind of focus on the course you're in or the course you just took or whatever, kind of cement that in your head while you're doing it, basically.
Pretty interesting. Okay. So that's a good one. That's a benefit. And I mean, and of course, throughout this course, if you ever find things that you think would be beneficial to your fellow classmates, always share. It's great to help out each other. But we're going to go ahead and call this class. I'll put up the material for the videos for you to review later this evening. And we're going to go ahead and call this one and pick up tomorrow. So y'all have a good evening, and I'll see you all. Hold on real quick. All right, perfect. Yep, and we'll see everybody tomorrow. Y'all have a
I
good
have a
evening.
question,
Oh, wait, Miss Leela. Go for it, Miss Leela.
just quickly. The
Okay.
video that you just shared, is that gonna be up as well?
It will be in the slide. Is where
Okay.
So when you go into the lecture, the one, my part, just click
Uh-huh.
in it and just scroll it over, and you can start it in the middle of the video.
Okay,
Yes.
thank you.
Anytime. All right. We'll take a break, or well, not a break. We're gonna go home, and we'll see everybody tomorrow. Y'all have a good night.